Hi, everyone. Jeff Clark here at goldsilver.com, back with you. And Mike Maloney is on the line with me again with another chart we want to go over. How are you, Mike?
I'm doing great, Jeff. How are you doing?
Good. So a coworker alerted me the other day to a couple of charts that you've put up recently, and it's the dynamic yield curve tool, I believe you call it. And I thought it was pretty cool. I thought it was very amazing. And basically, it's an update on the yield curve. So I wanted to get you on the phone real quick and talk about this. So first, for those of us that aren't real familiar with this, tell us what the yield curve is and why this is important.
Okay. Every time the Treasury has a bond auction, there's different terms for the different types of bonds and notes that they auction. There's a 3-month here, a 2-year, a 5-year, a 7-year bond, a 10-year, a 20, and a 30-year bond. And the percentage interest, the income that it's going to pay out, is plotted on these lines here. And so this red line is the latest bond auction. These are the interest rates that those bonds are paying at each one of these intervals. And then there's a little bit of shadow here from that's previous bond auctions. And with this tool, we can reduce the shadow or we can increase it. It's sort of nice to see. It gives you a sense of which direction things are going when you have that shadow on. And then what they've done is they've plotted this throughout time and against the S&P 500 large cap index here. And so you can see what the market does in relationship to the bond market. So the stock market in relationship to the bond market. And what's interesting, during when investors get worried, they run more toward the short-term bonds. There's people will liquidate other investments and go toward what they consider a safe haven, but they don't necessarily want to lock up their cash for a real long period of time, and that affects the yield that the bonds are going to have. And with this dynamic yield curve, you can take this little bar here and move it across, and what you see, what I find interesting, there's something called the yield curve, and that is this sort of positive curve. And then there's something called curve flattening, and this is a flat curve right here. It means that investors are a little bit spooked. They don't necessarily know which direction things are going. And then there's an inverted yield where short-term rates are higher than long-term rates. And with each one of these inverted yield curves, there's a crash that comes right after it. And I just find this very interesting. It's a very good tool. And you'll hear on the news, they'll talk about a flattening yield curve. This is a curve that's flattening right now as we go through time. And then we get to the year 2000 and the NASDAQ crash, and investors are panicked. And then the yield curve goes positive again. Now, right here, Alan Greenspan eliminated the 30-year bond for a little while, and so you see that doesn't move after it's pegged for a while. So ignore that. But you see a positive yield curve, and then again, it starts to flatten as we get into 2006 and the peak of the real estate bubble, and then it goes inverted here, where short-term yields are higher than the 30-year Treasury, and then it crashes. And as it crashes, it goes back to a normal positive yield curve. Then Ben Bernanke brought interest rates down to zero by pegging the short-term bond. And they do that by buying whatever quantity they need to buy to fulfill the Treasury auction at zero interest rates. And it goes positive again, and it's got a nice curve to it. This is the way a curve should be. Now, they've been raising interest rates recently, and you'll see the bottom rates start to come up. It goes from pretty much zero to about 0.25% here, and then we jump up to 0.5% now. But what's interesting, this is the flattest that the yield curve has been. And it's since they're talking about raising rates again, so this will come up here somewhere. This is once again becoming a useful tool because the Fed is slowly stopping its intervention.
And so the point is, as that yield curve flattens or even inverts, that's the time that the S&P has historically had a correction or a crash.
Yes, and it's beginning to flatten now. This is the flattest that it's been since the last crash.
So be careful with stocks right now. I think that's the message, right?
Certainly is.
Good. Okay, everyone. Hope you got something out of that. Thanks for joining us. Keep up with us at goldsilver.com. Don't forget we have a price match guarantee, fast shipping, and a special insiders program directly from Mike. Thanks for liking the video and subscribing, and we'll talk to you again soon.